Hello everyone, and welcome to episode 30. In this video, we'll be diving into the intricacies and details of intraday trading, what it is, how it works, and why it's such a popular and appealing style of trading for many traders. By the end of this video, you'll have a solid understanding of what it takes to succeed as an intraday trader. We will cover topics such as the different timeframes involved, both high and low. We'll also explore the key differences between intraday and swing trading, examining why these two styles cater to very different types of traders. Additionally, we'll discuss the paradoxes and myths surrounding intraday trading. Finally, we'll go over the objectives and goals of an intraday trader, diving into their mindset, what they are trying to achieve, the realistic expectations they need to be aware of, and how to define the daily candle range. By the end of this chapter, you'll have everything you need to know about intraday trading, helping you decide whether this trading style is right for you. Now, let's move on to the next slide and talk about intraday trading. Intraday trading, also known as day trading, is all about opening and closing trades within the same day. You're not holding any positions overnight or over the weekend. Everything happens within a single trading day. The goal is to profit from price movements that occur during that day, taking advantage of daily range expansions, reversals, or fluctuations within a single daily candle. Essentially, as an intraday trader, you're saying, I don't care where the market ends up tomorrow, I'm only focused on today's price action. That is the core premise of intraday trading. Now let's discuss how intraday trading differs from swing trading. While both are about making money, their approach and required mindset are fundamentally different. Intraday traders don't hold positions after the market closes. They are completely done by the end of the day. In contrast, swing traders hold trades overnight, over weekends, or even for extended periods, as their trades take more time to develop. For intraday trading, the objective is to capture the daily price range by capitalizing on range expansions within a single trading day. Swing traders, on the other hand, play the longer game, focusing on the weekly price range and looking to profit from longer-term market movements that take more time to unfold. Intraday trading is suited for traders who thrive on quick decision-making and have the mental capacity to sit in front of a screen, watching charts and reacting instantly. These traders know how to stay composed in high-stress environments and aren't easily distracted. Swing trading, in contrast, is better for those who are comfortable holding positions overnight or over the weekend without panicking. If you're someone who loses sleep worrying about market movements while you're away from the screen, swing trading may not be the best fit. However, if you trust your analysis and can stay calm while holding trades for days or weeks, then swing trading might be a great option for you. There are many other factors to consider when deciding which trading style suits you best. We'll dive deeper into these in the next chapter, where we'll discuss swing trading in detail. Now, let's move on to the next slide and discuss the myths and paradoxes of intraday trading. A lot of people misunderstand what intraday trading is really about, so let's set the record straight. One of the biggest misconceptions is that intraday trading leads to quicker success simply because the trades themselves are fast. Since you're in and out of trades within minutes or hours, you might assume that you'll achieve success faster. But that's completely wrong. The truth is, no matter how quick your trades are, you still go through the same learning phases and challenges as any other trader. Whether it's a swing trader or a position trader, there's no shortcut to success. You still have to learn your strategy, practice discipline and consistency, master risk management, and build confidence over time. Whether you hold a position for a few minutes or several days, the effort, time, and dedication required to master the craft remain the same. If you enter intraday trading thinking it will fast-track your success, you're setting yourself up for disappointment. Trading is a journey, not a sprint, and you must always keep that in mind. Another major myth is the overtrading trap, the false belief that more trades equal more profits. Many traders assume that if they're constantly trading and taking every opportunity, they'll make more money. But that's not just a myth, it's dangerous thinking. Overtrading is one of the fastest ways to drain your account. Here's why. First, higher costs. Every trade comes with transaction fees, commissions, spreads, and slippage. The more trades you take, the more these costs eat into your profits. Second, increased mistakes. When you take too many trades, you're more likely to act impulsively, ignoring your strategy and system. This is when errors start piling up. Third, emotional strain. Overtrading puts unnecessary pressure on your mental state, leading to frustration and poor decision-making. The reality is that trading less but with precision is always better. In intraday trading, the goal isn't to sit in front of the screen all day, taking every possible trade. Instead, it's about identifying high-probability setups, executing them with discipline, and stepping back. Just because you trade more frequently doesn't mean you'll make more profit. That's a straight-up lie, and believing it can be a costly mistake. Intraday trading may seem fast-paced and exciting, but don't let these myths mislead you. Quick trades don't mean quick success, and more trades don't mean more profits. To truly succeed, you need to focus on developing your skills, sticking to your strategy, and trading with precision. Even in the fast world of intraday trading, it's still about playing the long game. Now let's move on to the next slide and break down the key points of intraday trading. This is where we'll dive into the core principles that will guide you as an intraday trader. What to aim for, what to avoid, and how to make the most out of each trading day or session. First, let's talk about the goal of an intraday trader. The primary objective is simple: to capitalize on daily range expansion. The focus is on profiting from price movements that occur within the same trading day. Specifically, an intraday trader looks at the daily range expansion and seeks opportunities to take advantage of it. The key is to stay sharp, recognize high-probability setups, and execute with precision. However, this should never be mistaken for chasing every minor price movement. Success in intraday trading is about capturing the most probable part of the range, not every single fluctuation. Another common misconception is that intraday traders must trade every single day. That is not how it works. Some days, the market is choppy, the setups are unclear, or the volatility simply isn't there. On those days, the best decision is to sit out and protect your capital. A trader is not paid to trade, they are paid to trade well. The focus should always be on quality rather than quantity. On an average day, an intraday trader can expect to find roughly 2 good setups based on candle ranges in CRT, which could be either a reversal or a continuation trade. The key here is patience. There is no need to hunt for dozens of trades. Instead, the approach should be to wait for high-probability setups that align with higher time-frame liquidity zones. The most important thing is to stick to the plan at all times and avoid forcing trades just because the market is open. Another crucial aspect of intraday trading is understanding the role of higher time frames. The more confluence from higher time frames that supports an intraday setup, the better the trade is likely to play out. The daily and 4-hour charts provide a broader market perspective, which can significantly increase the odds of success. When an intraday setup aligns with a strong higher time frame draw on liquidity or a key level, the probability of a favorable outcome improves. Keeping an eye on the higher time frames is essential for confirming setups. Key levels, higher time frame draw on liquidity, and 4-hour CRT, candle range trades, form the foundation of a strong intraday trading strategy. These elements should always be factored in when planning trades. Understanding them helps in making informed and confident trading decisions. There are also days when the best move is not to trade at all. Major news events such as FOMC, Federal Open Market Committee, NFP, non-farm payroll, and CPI, Consumer Price Index reports, introduce extreme volatility and unpredictability into the market. During such events, stepping aside and protecting the account is often the smartest decision. Being a great trader is not just about knowing when to trade, it is equally about knowing when not to trade. These principles form the foundation of a successful intraday trading approach. In the next chapters, we will explore these ideas further and build a deeper understanding of how to apply them in real-time trading scenarios. Now, let's move on to the next slide and discuss framing intraday setups. When setting up an intraday trade, several key factors and variables must be considered to ensure the highest probability of success. The first and most important factor is higher time frame draw on liquidity. Your intraday setup must always align with the higher time frame liquidity. as this provides a clearer, bigger picture of market direction. When a trade moves in the same direction as the higher time frame liquidity, the chances of success increase significantly. I keep emphasizing this concept because it plays a crucial role in framing trades. The key takeaway here is simple: always trade in alignment with the higher time frame draw on liquidity. Next, we consider higher time frame order flow. While similar to liquidity, this adds another layer of analysis by revealing how short-term, intermediate, and long-term highs and lows influence market structure. Understanding these movements allows for better decision-making and positioning. Another essential component is the weekly candle direction. By analyzing the higher time frame structure, you can determine whether the weekly candle is likely to close bullish or bearish. Once this is established, your goal should be to take trades only in alignment with that expected directional move. One of the most critical parts of intraday trading is CRT, or candle range theory. This concept serves as the foundation of an entry strategy. Without properly identifying CRTs, it is impossible to frame a mechanical and objective entry. The key is to identify the correct CRT on the 4-hour time frame, align it with the higher time frame draw on liquidity, and use it as a basis for your trade setup. Another major element is key levels on the 4-hour chart. Key levels act as essential decision points in the market and are fundamental to trading success. If you followed my previous breakdowns, you already know how significant they are in determining trade execution. The day of the week also plays a role in trade selection. Each trading day has different characteristics and potential scenarios based on the framework of key levels, order flow, and draw on liquidity. Being aware of these variations allows traders to adjust their approach accordingly. Time of day is another crucial factor. Market behavior shifts depending on the trading session, and knowing the best time to execute trades can greatly improve efficiency. I will explain this concept in more detail later, but it is important to remember that timing plays a major role in trade success. Finally, we must consider range expansion, which involves understanding when, how, and where price will break out of a range to form an extended swing in the direction of higher time frame liquidity. Identifying the correct range expansion requires a structured approach based on key concepts, including liquidity, order flow, CRTs, and key levels. By constructing a cohesive and logical market narrative, traders can pinpoint the most favorable conditions for range expansion and act accordingly. By combining all of these elements, higher time frame liquidity, order flow, CRTs, key levels, timing, and range expansion, you can develop precise, high-probability intraday setups. In the next chapters, we will dive deeper into each of these components and explore how to apply them effectively in real-time trading. Now, moving on to time of the day, let's break down the key trading sessions and market behaviors that you need to be aware of when framing precise entries throughout the day. There are several important trading periods, including the Asian Session Open, London Session Open, London Lunch, New York Session Open, and the London Close Kill Zone. Each of these sessions, or kill zones, has its own distinct characteristics, behaviors, and market tendencies. Understanding these differences is crucial for executing well-timed trades. For example, the Asian session is typically known for its ranging behavior, commonly referred to as the Asian range. This session tends to establish key price levels that will later influence market movements in the London and New York sessions. The London session then builds upon the order flow and key levels established in the Asian session. Its behavior can vary based on prior market structure. If a key level or a high time frame candle range remains untested during the Asian session, then the London session may begin with a manipulation phase, commonly known as a Judas swing. In this case, the market often pushes towards a liquidity level before reversing and expanding in the opposite direction. The reaction at this stage depends entirely on the overall market framework and the structure that is currently in play. This same logic applies to the other key trading sessions. The New York session, for instance, often brings strong volatility and continuation moves, reacting to liquidity from both the Asian and London sessions. The London Close Kill Zone also plays a significant role, as it frequently marks key reversals or profit-taking points for institutional traders. Each of these time periods carries different implications depending on the higher time frame structure, liquidity positioning, and the overall market narrative. The goal is to use this knowledge to align your trades with the optimal time windows for execution, ensuring that you operate within high-probability setups. As we progress, we will go deeper into how to use these session behaviors to refine trade entries and maximize precision. Now, moving on, let's break down the day-of-the-week characteristics and how they impact intraday trading. Each trading day has its own unique behavior and understanding. These behaviors gives you a significant edge when planning and executing trades. The market doesn't behave the same way every day. Each day presents its own structure, order flow, and setups. Recognizing these differences helps you synchronize your system with the market's rhythm. When analyzing each day of the week, a few core variables must always be considered: order flow, key levels, candle ranges, market profiles, and weekly profiles. Starting with Monday, this is typically a range-establishing day. You often see the market forming a candle range, CRT, which then serves as an important reference for the rest of the week. Since the market is still setting up, it's usually not the best day for aggressive intraday trading, but it's a great day to observe, mark key levels, and prepare for upcoming setups. Moving to Tuesday, the market starts to gain momentum, making it a more favorable day for intraday trading. The range established on Monday plays a critical role, as Tuesday often expands on Monday's structure. The order flow becomes clearer, allowing more defined trade setups to emerge. Wednesday is one of the best days for intraday trading. By midweek, the market has typically developed solid structure, clear key levels, and defined order flow, making it easier to identify high-probability trades. Volatility is usually well-balanced, meaning there are opportunities for strong setups without extreme unpredictability. Similarly, Thursday is another prime day for intraday trading. It often continues trends that developed earlier in the week, or presents reversals if the market reaches key higher timeframe levels. By this point, the weekly range expansion is often nearing completion, and traders can capitalize on well-established key levels and price movements. Finally, Friday tends to be more of a risk-off day, meaning opportunities may be more limited. However, trading on Friday can still be viable if the weekly range expansion hasn't fully played out yet, or if the weekly objective remains unmet. Otherwise, many traders choose to reduce exposure ahead of the weekend. The key takeaway here is that each day plays a different role within the overall market structure. The better you understand this framework and how each day contributes to the bigger picture, the more precise and confident your trades will be. Now, let's move on to the next part of the chapter. In this final section, I will define the daily range for you based on time and kill zones. I will also show you how each session is coordinated and how various factors and variables play a role in its structuring and organization. Moving on, let's get into what an ICT trading day really means and why it's important to approach it with the right perspective. This concept can make a big difference in how you analyze the market. The retail trading day starts at 5 p.m. Eastern Standard Time and ends at 5 p.m. EST the following day. Alternatively, you could say it starts at 1700 EST and ends at 1700 EST. By following this schedule instead of the standard midnight-to-midnight approach, you are able to view price movement in a way that's more aligned with how the market actually operates. It gives you a more precise view of the whole daily range, including the different kill zones and sessions, which you'll see in just a minute. Moving on, let's first talk about the Asian range, what it is, when it happens, and how it influences market behavior. The timing of the Asian range begins at 8 p.m. Eastern Standard Time, 2000 hours EST, and ends at midnight, 0000 hours EST. The Asian range often sets the tone for the early part of the trading day. While we know this session typically has lower volatility compared to the other sessions, it is important because it creates a crucial structural framework that we can use as a guide to plan our trades throughout the risk of the day. This is why the Asian range is so important. We know that the Asian range often represents a period of consolidation, where price moves within a narrow range. This is when liquidity is being built up, setting the stage for potential expansion during the London kill zone, or perhaps the New York kill zone. We can use the price action in the Asian range as a guide. There are two main profiles that can emerge based on the orientation of the Asian range. First, we have the delay protraction profile, which occurs when the Asian range is an expansion profile. Then we have the normal protection profile, which happens more often than the first, when the Asian range is in consolidation. During the London kill zone, we typically see manipulation above or below the Asian range, depending on high time liquidity and key levels. From there, price expands in the opposite direction. To use the Asian range effectively, we mark the high and low of the Asian range on our chart as soon as it is established. These levels act as key reference points for later sessions. You should pay attention to how price behaves around the Asian range and the candle ranges on the 4-hour chart during the London Open kill zone. This will help you recognize whether the market is showing signs of a delayed or normal protection profile, allowing you to adjust your strategy accordingly. Now, moving on, let's break down the London kill zone. The timing of the London kill zone starts at 2 a.m. Eastern Standard Time and ends at 5 a.m. Eastern Standard Time. During this time, the market tends to break out of the consolidation range that was formed earlier during the Asian session. It also tests key levels and establishes the daily directional bias. The way the London session expands is heavily influenced by what happens during the Asian range, as well as other factors like candle ranges and key levels. Here's how it typically plays out. If the Asian session didn't reach or test a high time frame key level, the London session often exhibits a Judas swing or manipulation profile, then reverses to expand in the opposite direction. If the Asian session has already tested a high key level and has already pushed a 4-hour candle range, the London session is more likely to expand in the same direction without showing a manipulation profile. When the London session takes out a candle range, either from the Asian session or the previous day, it often signals a high probability time for those ranges to be pushed or cleared out, and we can frame our setup around this. That is what you need to know about the London kill zone. Now let's move on to the next slide, where we'll discuss the New York kill zone. The New York kill zone starts at 7 a.m. Eastern Standard Time and ends at 10 a.m. Eastern Standard Time. The price action during the New York kill zone is largely influenced by the progress made during the London session or the London Open zone. Based on that structural framework and price action, we can identify two main profiles, a continuation profile or a reversal profile. If the London session has not yet reached the daily objective, for example, it hasn't tested an opposing key level, taken out an opposing liquidity pool, or fully extended the range expansion, the New York kill zone is likely to continue the trend established during the London session. On the other hand, if the London session has already reached the daily objective, meaning it has tested an opposing key level or taken out a liquidity pool, the New York kill zone is more likely to trigger a reversal. In this case, price might manipulate early traders into thinking that the trend will continue, creating a false breakout or a liquidity grab. Afterward, the market will reverse in the opposite direction, either after a consolidation or immediately. These are the key features and profiles that define the New York session. Next up, we have the London close kill zone. It begins at 10 a.m. Eastern Standard Time, right after the New York kill zone ends, and closes at 12 p.m. Eastern Standard Time. The London close kill zone has its own intricacies and details, which we will dive into further in a future chapter. Now, moving on to the next slide, here you can see a price action chart. Based on this price action, I will define the daily range for you, taking into account the time of day and the kill zones. First, you can see that I've already plotted out the open and close of the day. This is a 15-minute chart, and it's important to note that during the day, you should make sure to mark out the open and close of each day. As I mentioned before, the open and close times are 5 p.m. Eastern Standard Time, 5 p.m. EST. The reason why you should do this is that it will provide you with a structural framework within which to start your analysis of the Asian session and other kill zones. This framework will make it easier for you to dissect the market and see how each session is playing out. Based on this, your decision-making process will be more efficient, allowing you to frame trades in a more objective, mechanical manner. Looking at the chart, you can see that we have a consolidation profile during the Asian session, which makes it the Asian range. Let's say there's a high time frame key level just above. During the Asian session, we never tested this high time frame key level. Instead, we formed a ranging profile and generated liquidity. Then, during the London kill zone, based on the structural framework of the Asian session, we had a manipulation profile with a Judas swing higher. This allowed us to test the high time frame level above us and take out the liquidity built during the Asian range. After that, during the London lunch session, we expanded and reversed lower. In the New York kill zone, we still hadn't reached the higher time frame objective or taken out high time frame liquidity, so the trend continued lower. During the New York kill zone, you can see that we reached down to the high time frame liquidity, tested an opposing key level, and based on that structural framework, we know that the New York session often leads to a reversal. This is exactly what happened. After expanding in the first half of the New York session, the market reversed after reaching the liquidity, and during the London close kill zone, we continued the reversal from the earlier New York session, closing the day higher. You can see that by using these timeframes and kill zones, and by analyzing the Asian session and its orientation, the price action becomes much clearer. Without these annotations and opening and closing times, the price action would be harder to interpret. This is how you define a daily range, and with this approach, you'll be able to easily frame a setup around it. So when you start your day, first plot out your opening and closing times. Then, as soon as the Asian session is established, mark it on your chart and note the high and low. From there, look at it in the context of high time frame key levels and liquidity, and make decisions based on that. The Asian session will act as a reference point for making decisions during the London and New York kill zones. That's all for this chapter. Traders, I hope you understand this chapter. If you have any questions regarding this video or CRT in general, please write them down in the comments. Be sure to backtest this or any other trading strategy you find on Flames and Trading. Once you're satisfied with the results, be sure to forward test your favorite strategy on a demo account. Remember that nothing in this video should be considered financial advice. This is purely for informational purposes. If you haven't already, please consider liking this video and subscribing to my channel so you don't miss out on future content. I upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently making a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter and join my Telegram. Thanks for watching. Till next time, happy trading.
Would you like to earn up to $10,000 just from sign-up bonuses? How about copy trading alongside professional traders like myself and these experts right here? With ByteFi, it's easier than ever. That's not all, there's no KYC required for all regional users. Plus, you'll enjoy a lifelong 20% cashback on every trade you make. And when you sign up, you'll also get a 10% deposit bonus. This totals 30% of your total trading budget. The link is in the description below.